Welcome to our CFP exam prep discussion on pass-through entity deductions, specifically focusing on the 20% qualified business income deduction. This tax provision, introduced by the Tax Cuts and Jobs Act, is a crucial concept that frequently appears on the CFP exam. Let's break down the qualified business income deduction, often called Section 199A. This deduction allows eligible business owners to deduct up to 20% of their qualified business income from partnerships, S corporations, sole proprietorships, and some real estate investments. Think of it as the government's way of leveling the playing field between C corporations and pass-through entities. Understanding the income thresholds is essential for the exam. For service businesses like medical practices, law firms, and financial advisory firms, the deduction begins to phase out at taxable income of $170,000 for single filers and $340,100 for joint filers in 2023. The deduction completely disappears at $220,50 for single filers and $440,100 for joint filers. For non-service businesses, these thresholds determine when additional limitations kick in, rather than when the deduction phases out. Here's where candidates often stumble on exam questions. They forget that for high-income taxpayers above the threshold, the deduction is limited to the greater of 50% of W-2 wages paid by the business, or 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property. Let me give you a practical example. Consider a manufacturing business with $400,000 in qualified business income, $200,000 in W-2 wages, and $2 million in qualified property. The potential 20% deduction would be $80,000, but you must test it against the limitations. 50% of W-2 wages is $100,000, and 25% of wages plus 2.5% of property equals $100,000. Since both limitations exceed the potential deduction, the business owner can take the full $80,000 deduction. Another common mistake is misunderstanding what constitutes qualified business income. Remember that QBI doesn't include investment items like capital gains, dividends, or interest income. It also excludes reasonable compensation paid to S corporation shareholders and guaranteed payments to partners. The exam loves to test these exclusions. When studying for this topic, focus on these key areas. First, memorize the income thresholds and phase-out ranges. Second, understand how to calculate the limitations for high-income taxpayers. Third, know what income qualifies as QBI and what doesn't. Finally, be able to identify specified service trades or businesses because they face more stringent limitations. A quick tip for the exam. When you see a question about pass-through deductions, immediately check the taxpayer's income level. This will tell you whether you need to apply the wage and property limitations or if you're dealing with a phase-out situation for service businesses. Also, pay attention to whether the business is a specified service trade or business, as this dramatically affects the availability of the deduction at higher income levels. The qualified business income deduction is temporary and scheduled to expire after 2025 unless Congress extends it. However, for exam purposes, focus on the current rules and calculations rather than potential future changes. The exam tests what is, not what might be. Remember, this deduction can significantly reduce a business owner's taxable income, making it a powerful tax planning tool that's worth mastering for both the exam and your future practice.